In this video, we're going to discuss other measurement and disclosure issues. We'll start with an introduction, then we'll talk about interim reporting, segmented reporting, related party transactions, and we'll finish up with subsequent events. Introduction. As accounting standards have evolved, the importance of full disclosure, or of the full disclosure principle, has become increasingly apparent. The diagram here shows the sources of investment information that investors use, and then subdivides those sources based on the amount of regulation that applies. Accounting standards govern the reporting of financial statements and notes to financial statements in the darkest turquoise here. There is some regulatory guidance for other types of financial reporting, such as management's discussion and analysis and shareholder letters, and then there is other information available in the market, which really isn't subject to any formal regulation at all. Within accounting standards, disclosure requirements have been increasing from the very beginning. There was a significant jump for public companies back in 2011 when we migrated to IFRS from the pre-changeover Canadian GAAP. It's estimated that on average, the volume of disclosures in IFRS are 30 to 40% greater than that of pre-changeover Canadian GAAP. For private entities, the disclosure volume technically decreased when ASPE standards were introduced. This was done very deliberately as the Accounting Standards Board tried to reduce the disclosure requirements for private entities to better reflect the cost-benefit relationship involved in producing the disclosures. However, now that ASPE standards are in place, it's probably fair to say that they've resumed a slow but steady increase in requirements. Why are disclosure requirements increasing? There are really two main reasons. First of all, the business environment has become increasingly complex. And so more information is required to accurately convey an entity's business activities. On a related note, the complexity leads to more interdependencies and conditionalities for business, and more disclosure is required to convey those conditions. The other major reason is that users are demanding more information, and at more frequent intervals. The fact is that the value of information decays rapidly with time, and investors are continually seeking the most current information they can find. Finally, financial reports are increasingly including information to be considered to be reported in the public interest, including things like management compensation levels, environmental compliance, related party transactions, and illegal activities. It is with these general trends in disclosure requirements that we look at a select group of issues within this chapter. So, again, we're going to cherry pick the issues we're going to look at within the chapter and focus just on that limited number of issues. The ones we're going to look at: interim and segmented reporting, which are requirements under IFRS only. They don't exist within ASPE. And then related party transactions and subsequent events, which have guidance both within the IFRS and ASPE standards. So interim reporting is the first topic. The key issue with interim reporting is how to go about approaching it. There are two competing viewpoints as to the best approach. Under the discrete view, proponents advocate treating each reporting period as a self-contained mini-year. As such, accruals and items such as cost estimates are recorded as they happen, or across the reporting period only, not across the entire year. The other approach is called the integral view. The philosophy under this approach is that you're reporting on part of a larger period, and thus it is appropriate to make, for example, accrual estimates based on full-year expectations. In practice, the difference is that, all else equal, interim reports would be more volatile under the discrete approach. than under the integral approach. And since management as a rule wants to limit volatility and manage earnings, they would tend to favor the integral approach. Many sins can be disguised through income smoothing, and that's what the integral approach allows. So what did the standards decide? The winner is the standards generally reflect the discrete approach, the volatile one. The only exception to that rule is income tax expenses. So where there are graduated tax rates that would apply, preparers are allowed to estimate an annualized tax rate in their preparation of their period financial statements. Practical interim reporting challenges. So let's think of a few things. Seasonality. Under the discrete approach, seasonal businesses must report their quarters as they happen. So costs and revenues may not be allocated across the year to smooth out seasonality. Think of a business like Canada's Wonderland. In Canada's Wonderland, for quarter one of the year from January to March, they have costs, but they probably don't have a lot of revenues over that period. Most of their revenues take place through the summer. One-off adjustments. So if you have write-offs or significant changes in estimates treated discretely, you can end up with very strong-looking or very weak-looking quarters. And finally, EPS, earnings per share. It's calculated based on the quarter as a standalone period. So that's it for integrated reporting. Let's look at segmented reporting. If it will allow me to get to the next slide. So again, segmented reporting only required under IFRS, or IFRS only provides guidance. Why is it required? Well, we have to go back to the objective of financial reporting in the conceptual framework. As you'll recall, the objective of financial reporting is to enable investors and creditors to forecast future cash flows and returns on investment so that they can make a decision as to whether they want to invest in a corporation, stay invested in a corporation, or sell their investment in favor of some other investment. A problem arises when an entity has multiple operating segments which display different risk profiles, different growth rates, and economic environments. In order to accurately forecast such an entity's performance, a user really needs to be able to isolate each major segment and then separately forecast each. Hence the requirement for segmented reporting. So, how do we identify reportable segments? Well, we use something called the management approach. This approach is based on the way the Chief Operating Decision Maker, or the CODM, allocates resources within the entity. Often, the organization is structured so that a segment manager with direct accountability to the CODM is in place, and that makes it fairly straightforward to identify the segments. Let's go a little further into the definition of an operating segment. Technically, an operating segment is a component of an entity which generates revenues and expenses by engaging in business activities and is allocated resources based upon regular reviews by the CODM and for which we do have discrete financial information. So you need to meet all three of those criteria. Operating segments usually have products and services that are similar in nature, or similar production processes, and similar customer and distribution channels. Operating segments must be reported if they meet the so-called 10% test. That is, either their revenues are greater than 10% of the combined revenues of all the operating segments, or their assets are greater than 10% of the combined assets of all the operating segments, or, and this is the trickiest one here, their profits or losses are greater than 10% of the combined profit and loss measured at absolute value of all operating segments. So, if they meet the 10% test on any one of those three, revenues, profits and losses, or assets, they're reportable. The combined revenue of reported segments must sum to at least 75% of the total revenues. If it doesn't sum to at least 75%, then some additional segments will need to be reported until the entity reaches the 75% threshold. Segmented reporting is shown in the notes to the financial statements. The example shown here is an excerpt from Note 20 of Canadian Tire's financial statements. It's called Segmented Information. It's actually quite old. It's from 2010. It's not a beautiful image, as you can see, but it'll do. What we're looking at across the top is Canadian Tire's business segments, including CTR, Canadian Tire Retail, financial services, that's their options MasterCard, for example, petroleum, the Canadian Tire gas stations, Mark's Work Warehouse, owned by Canadian Tire, and then eliminations, and the total. Down the side are the various metrics that they are reporting for each segment, including, hard to read, but this says gross operating revenues, earnings information, interest revenue for their financial services division, and total assets. The values shown for segmented reporting, again, are not necessarily statutory GAAP values. Rather, they are the values that the CODM looks at when making resource allocation decisions. For example, in segmented reporting, common or joint costs, such as the cost of the key executive group or the cost of corporate headquarters, they're not allocated because allocations are inherently arbitrary. Similarly, intersegment purchases and sales are not necessarily eliminated as would be required for regular statutory reporting. In fact, you can see in the Canadian Tire example that intersegment revenues are not eliminated because there is a separate elimination column at the end which brings down the total revenue value to the overall total net of elimination. So let's go back there. So you see, without these eliminations here of about $100 million they're reporting, their total revenues would not equal what is shown on the income statement. So I guess something's happening. There are sales between maybe Mark's and Canadian Tire Retail, or between Canadian Tire Retail and the financial services. There's sales between those entities. So those sales are being shown here, even though they would not be in the grand total. Okay. Drawbacks of segment reporting. Management tends to dislike it, and the most often cited reasons for this dislike are, first, users may draw incorrect conclusions from the information because of erroneous assumptions. So management considers it dangerous information. They also worry that the segment information is a gift to competitors. They argue that the information can't be readily or validly compared with other entities anyway. And finally, there is the real possibility that management could well be disincented from taking business risks within an operating segment because any failures that they run into will be visible through the segmented reporting. Okay, Let's move now to related party transactions. Related party transactions are transfers of resources, services, or obligations between a reporting entity and a related party, regardless of whether a price is charged. Standards that deal with related party transactions actually exist under both ASPE and IFRS. And the most notable difference is that it's actually ASPE that is more stringent in this case. That's not something we often see. It's usually IFRS that is very stringent, but not this time. The specific point on which IFRS and ASPE differ is that certain types of related party transactions are required to be remeasured under ASPE. And that essentially means that they are reported as if those transactions took place at cost, even though the legally agreed exchange amount, or let's say sales price, was different. Okay, so ASPE reports at something different than what the legal exchange price was. Under IFRS, remeasurement is never required. They require disclosure only. So whatever is the legally agreed exchange price, that's the price that gets booked under IFRS. Okay, how do we define related parties? First of all, they are determined based on the economic substance of the relationship, not necessarily the legal form. So a person is related if he or she has control, joint control, or significant influence over the entity, or if the person or their key close relatives is part of the key management of the entity or the parent of the entity. Okay, so those are for natural persons. An entity is related if the entity and the reporting entity are members of the same group. So maybe they are associates or joint venture partners. Or if a related person jointly controls, or has significant influence over the entity. Or if a related person holds a key management position in the entity or a parent thereof. Those are a bit hard to take in, a little bit legalistically sounding, but those definitions are useful when you go to apply defining who a related party is. Why do we care about related party transactions? Well, related party relationships can affect the financial position and the financial performance of an entity, even if no transactions take place. For example, a related party may direct an entity to avoid a particular market segment, or to not engage in research and development, which might not necessarily be in the best interests of the entity. So, while related party standards don't require reporting of these kinds of directions, they do require reporting of the relationships. And from there, users may be able to surmise the reasons for actions that the entity does or does not take. As well, related party transaction terms may differ from those of arm's length transactions. For example, payment terms or pricing may be more favorable to related parties than to arm's length parties, which again may or may not be in the best interests of the entities. It is important for users to be aware of the scope of related party transactions on an entity, and related party transaction standards require this type of disclosure. Finally, related parties may enter into commitments with each other that they would not enter into with unrelated parties. Such commitments may affect the entity's ability to access financing, to access better pricing in its financing, or to enter into other transactions that ultimately affect profit and loss. For all of these reasons, it is important that information on related party transactions is provided in the financial statements. Okay. Again, the IFRS standards really just mandate disclosure about related party transactions, and the key disclosures are listed here. So you can see it includes what are the relationships between a parent and its subs, compensation of key management personnel, and then where there are related party transactions, a bunch of information about those transactions. The extent of disclosure will depend on the significance of the transactions, obviously with more disclosure required for more significant transactions. And indicators, how do we define something that is a, quote, more significant transaction? Obviously large transactions, but other indicators would be those that are not in the normal course of business, or those that are carried out at non-arm's length terms, or those that actually required shareholder or key management approval. They're obviously strategic. There's something important about those transactions. Okay, as was mentioned earlier, ASPE standards require more than just disclosure. In some circumstances, they require that the related party transactions be measured at carrying value rather than the exchange value that was legally agreed and transacted. So when do related party transactions meet the remeasurement criteria? Well, there are two key judgments. First, is the transaction in the normal course of business? If it is, then it's measured at the exchange value and no remeasurement is required. But if the transaction is not typical of normal business activities, it may need to be remeasured. You have to go on to the second key judgment to decide. The second key judgment is whether or not there is a substantive change in ownership interests. In this test, you look at the ownership interest of the highest level of the related group both before the transaction and after. If the overall ownership interest hasn't changed by at least 20%, then we don't have a substantive change in ownership, and we can't assume that the exchange amount is an arm's length value. In this case, the transaction is measured not at the exchange amount, but rather at the carrying amount. We'll look at an example in a few minutes to illustrate the remeasurement. Before we look at the example, let's consider non-monetary transactions, which may be more common in related party transactions. Non-monetary transactions are exchanges of non-monetary assets, liabilities, or services for other non-monetary assets, liabilities, or services, with little or no monetary consideration. The threshold for little or no is 10% or less. Why might these be more common in related party transactions? Well, because they allow related parties to move assets around and profits around without having to move money. That's right, the cold hard cash part around. Moving assets and profits around might be in the best interests of the overall related party group. But if you hold shares in just one entity within the related party group, you want to be sure that this type of transaction is in the interest of the entity you're invested in. What you don't want to see is profits and potentially cash payouts being transferred from the entity you're invested in to a related party entity in which one of the owners has a much more concentrated interest. Okay, so back to those non-monetary transactions. The key judgment you have to make in non-monetary transactions applies whether or not the transaction takes place between related parties or not. The key judgment is, does the transaction have commercial substance? That is, does it result in a change in the risk, timing, or amount of cash flows? If yes, then the transaction is measured at its fair value or its exchange value. If no, then the transaction is measured or recorded at the carrying amount. So how do we actually remeasure transactions at the carrying amount? Well, when you measure or record a transaction at the carrying amount, there is no gain or loss associated. When you measure at the exchange amount, though, a gain or loss is generated. So what we do when we remeasure is essentially that we reclassify those gains or losses. Losses are reclassified first to contributed surplus. If a credit balance exists, if a credit balance exists as a result of previous related party transactions. After that, they go directly to retained earnings. Gains, on the other hand, goes directly to contributed surplus because the gain is considered to essentially be a capital payment from one entity to another. Okay, let's look at that example now. So here we go. Big company owns 75% of small company. During 2011, Big purchased a building from Small for $1,000. The building's carrying amount in Small's financial statements is $700. Big's contributed surplus contains a credit balance of $200 from previous related party transactions. Small's contributed surplus account is nil. So the required is to give the journal entries for both Big and Small, assuming A, that the transaction goes at the exchange amount, and B, that it gets recorded at the carrying amount. So let's look at the answer to A. If the transaction is recorded at the exchange amount, this is like normal situation that we're all used to. Okay, so Big bought a building for cash. They paid $1,000 to buy this building. Great. Big's entry is debit building for $1,000 and credit cash. Small's entry is that they sold a building that was carried on the books at $700 for $1,000. That leaves us with a gain of $300. Simple. At the carrying amount, it's a bit more complex. So Big's entries. First of all, the building is going to come in at the carrying amount, $700. So that is Small's carrying amount. However, the fact is that Big did pay $1,000 cash to Small. So we have to credit the cash for $1,000. What do we do with the $300 difference? And look at these things are actually on the wrong side. What do we do with the $300 difference? First, we soak up the contributed surplus balance, which Big carries, related to previous related party transactions. And the question said they had a $200 credit balance. So we are going to debit contributed surplus for $200 and draw down that entire contributed surplus balance. But that's not enough debits. We still need another $100 worth of debits. So they go to retained earnings. On Small's side, they're going to credit their building for $700. Yep. And the fact is they did receive $1,000 of cash from Big. But they're not going to record a gain. Instead, they're going to record a contributed surplus for the difference instead of a gain. The $300 goes into contributed surplus. It's like the parent company, Big, gave them a $300 equity injection. They just did it by paying more for the building than the carrying value of the building. So that goes directly into contributed surplus. Disclosure requirements under ASPE, quite similar to IFRS really. a description of the relationship between the transacting parties, a description of the transactions and some details about those transactions, the amounts that are due to or from related parties at the end of the year, so like payables and receivables, any contractual obligations with related parties, and contingencies. The extent of disclosure. Materiality should be considered, of course, on a quantitative and on a qualitative basis. And for related party transactions, that qualitative component of materiality is particularly important because related parties transactions are often more significant to users than equivalent transactions with non-related parties. So their threshold of concern is lower. They want to hear about even low value related party transactions because they want to understand what's happening between those related parties. Last topic, subsequent events. So before we get into what subsequent events are, let's clarify the period during which subsequent events take place. The subsequent events period is the period immediately following year-end up until the financial statement issue date. So in the diagram, it's this yellow period. So we're talking about the financial statements for this period, like last year. And here we are in the subsequent events period, the month or two between the actual balance sheet date, let's say for example December 31st, and the date we issue the financial statements, which is, maybe the end of February, maybe mid-March. Defining the financial statement issue date. Actually, it can be defined in a number of ways. In IFRS, it's defined as the date on which the financial statements are authorized for issue. For ASPE, however, the date depends on the management structure and the reporting procedures. So there's actually more judgment involved under ASPE in determining what actually is the financial statement issue date. Okay, what's a subsequent event? Okay, it's an event that takes place between the balance sheet date and the financial statement issue date, so during that subsequent events period, that materially affects the company's financial or operating situation. There are two types of subsequent events. The first is an adjusting event, one that provides further evidence about conditions that did exist at the balance sheet date. For example, something that helps the preparers refine the estimates they made at the year end. Something like the settlement of a court case. Before settlement, the entity had to estimate the settlement amount. But if the lawsuit, for example, or the court case, is settled in that subsequent events period before the financial statements are issued, well then they don't have to estimate the settlement amount when they issue the financial statements because they now know what the settlement amount is. Okay, the second type, non-adjusting subsequent events. These ones, on the other hand, don't actually relate to conditions that were in place at year-end. They really are new events. However, they are sufficiently important that the financial statement users need to know about them in order to fairly reflect on the company's past performance and future prospects. So some examples of non-adjusting subsequent events are the issuance of shares or debt, or something like the purchase of a business or the decision to abandon or sell one. Now let's bring in the accounting for subsequent events in our final slide here. Not surprisingly, adjusting events result in adjustments to the financial statements. Again, we're talking about last year's financial statements. So if we're sitting here in February 2021, last year's financial statements are those for December 31st, 2020. So adjusting events result in adjustments to the prior year financial statements, and they help to more accurately present the company's position at the year end. So when we say financial statements are adjusted, that means we make a journal entry. And disclosures might need to be updated accordingly as a result of that journal entry that we just made and the additional detail we have about the year-end condition that clarified through the adjusting event. For non-adjusting events, the face of the financial statements doesn't change. However, there are changes to disclosures. And those changes are made to provide financial statement users information about the subsequent event. Finally, an event that threatens the entity's ability to continue as a going concern is a particularly extreme subsequent event. An example would be something like a catastrophic lawsuit, or perhaps the loss of several major customers, or perhaps an airline business facing the impact of COVID-19. In that case, the entire set of financial statements has to be adjusted to show liquidation values. And that's the end of the video.